This is the worst financial advice that I have ever heard. It's that you should be your own bank by purchasing permanent life insurance, also known, thanks to the online universe, as infinite banking. So let me tell you a little backstory first. My parents purchased policies like these, and guys, they are not new. They are new marketing slogans on the same exact products. So my parents purchased this in the 80s, and they upfront funded it with $100,000. $100,000 that they were told they would one day retire off of, and that it would grow to be worth at least $500,000 by retirement. They were in their early 30s at the time. And so what happened? They put that money in, they moved out of the country, they came back later on, kids grow up a little bit. The time I'm 16 years old, we realized that the premiums, the payments on this policy have started to rise. So they went from no payments, they had paid it all up front and were promised that would be it, to owing payments every single month. At the same time, I know this sounds insane, but my dad gets diagnosed with cancer. So we're stuck in this policy. We can't replace it even if we want to. He's uninsurable at the time. And so they start to make payments. You can imagine, not ideal to have to make payments at a time when you are sick and have young kids. And so we continue on with this, and we find out later on, it becomes my career later on. My sister gets licensed as well. We go to visit my parents, we dig into this policy, and we actually end up suing that insurer in a class action lawsuit. My parents win. They're awarded $6,000 in that class action lawsuit, and they were able to take out their cash value, which is the balance that had grown over all those years from the 80s to now we're talking about deep into the 2000s. So in that time period, they'd put $100,000 in, they get a $6,000 lawsuit benefit, and they cash out that policy for $70,000. So they walk away with $76,000 over 20 years later from this policy. Well, you might say, well, at least they got some money back while they were insured. I get nothing back if I buy term. Let me tell you the real numbers, because thanks to my career, I've been able to do this and to actually analyze it and run historical performance. If they had bought term and invested the difference in the 80s when they bought this policy, and they had continued to pay for that life insurance out of pocket and left the rest invested in an average fund, literally just an average growth and income fund, it calculated to be about $3.4 million that they would have gotten back in their 60s instead of the $70,000 and the $6,000 that they got through the lawsuit. $3.5 million. Ask yourself today, if it's you, if it's your family, if it's the people around you, which one would you choose? And so I want to break down for you, because I know the choice, right? I know the regret that my parents, smart, hardworking people, immigrants, like most of the people that these products are sold to, they didn't have the same access, they didn't have the same financial literacy in North America at the time. I want you to know how these actually work. All right, so let's go ahead and debunk it piece by piece on all the stuff that they use really as attraction mechanisms for new clients. So the first thing they're going to tell you is that the Rockefellers did this. This is how they created wealth. And I want to tell you quite simply that you can't be your own bank or create wealth if you don't already have some money. So the Rockefellers did not become rich by using life insurance. They had businesses and they invested in appreciating assets. Most importantly, those assets went into a trust, and that's what protected it and made it continue to grow and sustain the next generation. These policies are going to tell you that you can pay now and be covered forever. Not the case. That's based on estimates and hypotheticals, and at any point you could end up owing money again. They're going to tell you that it's going to grow tax-free. Not true. It is tax-deferred growth. If you have ever put money into a policy and taken it out and not owed tax, there's a simple reason. You had no actual profit, okay? You had no gain. So they did an adjusted cost basis, what you put in, what it costs you to keep that policy. You take it out. If there's zero profit, then you're right, it is tax-free. They're gonna tell you you can leave your money in and borrow on your own money. Well, that part is true, but what they don't tell you is you have to pay interest. And typically in a whole life policy, that interest, 6 to 8% per year. And it's not paid to you like in a 401k loan. It is absolutely paid to that company in a product that, if you look up historical returns, if you're talking about whole life insurance, it's like checking or savings accounts combined with life insurance. That whole life product probably returned between a 2 and 4% interest rate, but they can borrow you 6, 8, sometimes 10%. Sorry, they can charge you 6, 8, 10% to borrow your own money. So that's a loss, guys. There's really no way to do that math and make it anything but a loss. What else? What else do they have? They're gonna say, well, you're covered till you're 100 years old, and so I need this because what if I die when I'm 100? Hey, my grandma lived to 99. God bless her. I hope I match her health and longevity. But at 99 years old, none of her kids or grandkids or her 12 great-grandkids were waiting for Yaya to leave us her wealth. Instead, she had prepaid her final expenses and no one needed anything from her and she didn't need anything from us. When you need life insurance is when you have dependents, people that need something from you. You have young kids, you have anybody who needs your income and you're still actively working for that income, you need life insurance. So what should you do instead? Use those dollars and instead of having 100,000 till you're 100, you should get 1 million or more when you're young and you have those dependents and everything else should go into the stock market. Last couple points. We've got new variations on these products coming out all the time. We had whole life, then we had universal life, indexed universal life, return of premium, all fundamentally the same. Life insurance and a savings component wrapped into one. Because they're wrapped into one, the insurance companies can charge you life insurance fees, morbidity, mortality fees, policy fees on the investment component as well. Because of that and because of the limited options, it's never going to be better than a pure investment. And when you get into the most recent product, the indexed universal life, they're going to sell to younger clients, people in their 20s and 30s, and they're going to tell you that you can get all your money back and as a bonus you get life insurance. You need to read that policy and see something called cap rates. What are cap rates? It means if you're in the S&P, it should invest like the index, but your cap rate is 8. If the S&P does 24 or 26%, like these great years we've seen, you never make more than 8. That cap is your limit on profit. So bottom line, guys, these policies and the people selling them and creating these videos, they promise a whole lot. They don't deliver on most of that. Your best option will always be to buy a true, pure, high-quality investment. Get it tax deferred if you can through a Roth, through a 401k. Talk to a specialist on that. Tax shelter, protect it, get it invested. Beat inflation, weather those fluctuations, build some real wealth for yourself while you're doing it. Protect the in-between while you're building your wealth with a simple, high-quality, low-cost term life insurance policy. Okay, so if you have one of these policies, what do? You're not trapped in it. In fact, life insurance is a one-sided contract. Once you're approved, they have to honor the contract. You can walk away at any point. And so many people will say, but I've already spent this many years and this many dollars. I don't want to walk away now and lose it. Hey, I always give the same analogy. If you went to a surgeon and they cut off the wrong arm or the wrong leg, would you give them a second chance? I know that sounds extreme, but the truth is, spending more on this product doesn't make it better. So what can you do? You can transfer out the cash value. It's called a 1035 exchange. You could keep it tax sheltered if you still have some money in there. You could just cancel, cut your losses and move on. Don't cancel until you've been approved for a new policy though, because you never know what might come up in health and all that kind of stuff. But bottom line, you have options, you have power, you have control. And you deserve that your dollars are spent in a product you understand and that serves your family correctly. So reach out if you need guidance, help, and advice in this area and anything else that helps make your money make sense.